Well, good morning. I'm Elliot Kallen, and I would like to welcome you to Meet the Expert. This is our 5th episode. We're very excited. We've got hundreds of people on these Zoom calls, the new world of Zoom. It's kind of, I laugh a little bit with Zoom. They're making fun of me in my office for being a Zoominator or some other term that they're giving me. And obviously, I like this a lot more than WebEx. I don't get paid to say that, and I don't own any Zoom stock. So we're glad to have you this morning. Here in May, coming to the end of May very shortly. We've got an exciting show today. We've got several exciting shows coming up, and we're getting great feedback. Just so you know, this is being recorded. You can use the chat line at the bottom. You can raise your hand at the bottom, and I will ask the questions and make sure every question gets asked if it's a good question. And we glad you're here. Let me tell you that we had the Social Security folks speak at the last one and got so much feedback that we're going to run another Social Security program in June. Sometime in June, we're going to run a report, one on cybersecurity in June, and then we're going to run on behavioral motivation and what clients do to help themselves, but also what clients do to shoot themselves in the foot. And so that does happen in our world, unfortunately. You know, years ago there was a study put out by Vanguard that said this is several years ago, that the S&P 500 for 10 years had done about 9% per year, that clients with advisors earned about 7% per year, and clients without advisors earned 2% per year, which means they sold at the wrong time and bought on the highs and sold on the lows. Unfortunately, we're all guilty of doing that way too often. So we're going to talk about this. We've got a rebound coming in some form, unless you're truly bearish. We may experience more of a bottom, which would be a W in this world rather than a V, which is what we're experiencing right now. So we're at 24,000 and such on the Dow. Don't be surprised if we touch the lows of 20 or 21 or not. It's hard to believe it's done what it's done already, but there's certainly in the news, there's so much optimism right now that this is making a world of difference. So we're buying on optimism and the news rather than what we did in March, which was sell on pessimism and the news. There's also Monday. I want to recognize that Monday is Memorial Day. So I want to thank all those families who have lost someone they cared about in war, in peace, whenever that took place, whether you're a peace officer, a fireman, Coast Guard, Army, Marines, Navy, Air Force, whatever you were in. I want to thank you on behalf of your team here at Prosperity Financial Group for all of your service. I am the CEO. I'm Elliot. We have several reps that are working here that would love to do your business. Please take a look at our website, and you can make appointments with all of us at www.prosperity, the word prosperity, F like financial, G like group, prosperityfg.com. And you can easily make an appointment there or send an email to me. You just put the name Elliot in there. That's 2 L's and 1 T, ELLIOT, at prosperityfg.com. And so let's get into our show right now. And I'll give you a few more commercials as we go. For our website, there are no commercials with this for any product. It's not product specific. This is an educational program. So let me tell you who we have on. The folks this morning that we're going to begin with are from JP Morgan. Everybody in this audience knows who JP Morgan is. Started many, many years ago, decades ago with his father-son program, where the son really created the program, as we know, of JP Morgan, founders of Edison Electric, which became GE and so many other great companies out there. They started as bankers, then became investment bankers, then became an investment house only. Then in 1987, 88, branched out even more. And then in the 90s were forced into becoming a bank by the federal government. So they're one of many banks that you can love or hate in this world, but they're huge. And of course they own Chase. So that makes them the largest financial, or certainly close to the largest financial institution in this country, one of the largest in the world. So today we have Brendan Coyne on. Brendan is the vice president that calls on me. We use their products. We are not JP Morgan. We are an independent registered investment advisory house. And we go to companies like Goldman Sachs and JP Morgan and many other companies and say, give us your all-stars, give us your all-star products. Don't give us your 20, 30, 40 products. Give us your 3 or 2 all-star products that really can knock the socks off, knock the cover off the ball. That's what we want to use, and that's what makes us, I think, the best choice for clients out there. And he's going to be working with Bob Fields, who's a managing director there, primarily works with fixed income, but they're going to talk about the rebound, the economy, what's happening, why the market's going up when we've got a lot of bad economic news in the second quarter. Still a lot more to come out with unemployment and GDP dropping dramatically, 30, 40%, whatever that is. So why is the market going up? And how do you make money working in the marketplace with people like yourselves or people by yourself? That's what we want to do. So they're going to bring it back to me when we're done. And then we've got Patrick Gallagher from Neuberger Berman, another very large institutional house. That's going to talk about aspects of estate planning, a little bit of it. So Brendan, let me turn this over to you, and from JP Morgan, our VP, and he's going to bring on Bob Fields. Brendan?
Thank you, Elliot. What a great introduction. I'll just say briefly at the outset before we turn it over to Bob, 2020 is certainly going to be looked at as the year of recession, the year of coronavirus. It's going to be a very deep recession. We're already in one, but we also think that it's going to be a time where you want to position for a very rapid recovery. Elliot referenced U-shaped recovery, V-shaped recovery, W-shaped recovery. There's many letters of the alphabet that are thrown out there. We are in the U-shaped recovery. Do we think we can test the lows again of March? Perhaps. It's not our base case. The best way to cushion yourself from the downside is to be thoughtfully diversified. Primarily what I mean by that is within fixed income. So 2021 should be a year of recovery. You need to position yourself for that too. So it's an interesting time. You want to be positioned for recession, but also prepare for the recovery. And it's a different balancing act. Recession's much different than prior recessions in that it's self-inflicted. What does that mean? That means that we shut down this economy like a light switch, and we're going to have to turn it on with a dimmer switch. So very easy to shut down the economy, much more challenging to turn it on, and we're in the middle of that right now. If you look at different areas of the globe out there, there is nowhere that is not in recession. Different areas of the globe are going to emerge at different paces. So much different than the recession of 2008, 2009. We think that this recession lasts more like an average recession. Think 12 to 15 months, or even a more brief period than that. And there's a variety of reasons that we talk about that, and I'm going to have Bob go into them. Traditionally, what has caused past recessions, there's been three main factors. High inflation. So high inflation or unforeseen inflation. Do we have that? No. We have very low inflation. You see where the price of oil is right now. It's probably going to remain there for some time. Please excuse me, I'm battling some severe allergies, but I feel fine. The second catalyst for recession, an aggressive Federal Reserve trying to cool down an overheating economy. I'm going to let Bob talk about that. The third is extreme valuations. That means the stock market is overvalued. And right now, the stock market is undervalued. There's a lot of volatility in the stock market. We expect that to continue. We don't say that to alarm or scare you. We just want to prepare you. As Elliot said, volatility can be your friend if you're thoughtfully diversified and if you've got dry powder and you've got a plan of what to do when the market does sell off. So it's a global recession caused, really self-inflicted recession caused by the coronavirus. Very low interest rate environment probably continues. Bob, I'm going to pass it over to you to talk about what the fixed income sees in terms of volatility, not only in fixed income and in rates, but what that means for the consumer, because the consumer here in the United States is the key driver of our economy. And right now, the consumer, to put it very lightly, is suffering tremendously. So Bob, why don't I turn it over to you for a little bit, and then I'll come back in about 5 minutes.
Sure. Thanks, Brandon. Hopefully you guys can hear me okay. You have to realize that 70% of GDP in the United States is based on the consumer. It's on what we consume and what we spend money on. So you have to realize that in this environment, with this whole shelter-in-place environment we're in, we're not going out to restaurants and dining in. We're not going to shopping malls. And as a result, consumption has dropped dramatically. And that's really as Brendan said, the cause of this recession is due to COVID-19. And the fact of the matter is, it's how deep it's going to be will be based on how much the consumer is, or how long the consumer is sheltered in place. Let's face it, Brendan described the causes of recessions in years past. Clearly an aggressive Federal Reserve is not causing this. An aggressive Federal Reserve would suggest that the Federal Reserve is increasing rates dramatically. Obviously, that's not happened. In fact, we commend the Federal Reserve for being quite proactive in pushing rates down. They pushed down that overnight Fed funds rate to essentially zero. They've been very, very proactive in making sure that the bond markets are liquid. Now, during the financial crisis, the Federal Reserve literally could control how deep the recession was or whether we avoided a depression or not. And the reason was the cause of the financial crisis was due to, over-levered borrowers, housing prices inflated, financial institutions doing inappropriate things. And the Federal Reserve could assure that we avoided a depression. The cause of this recession has nothing to do with the Federal Reserve. They cannot control how deep this recession is, but what they can do is make sure that the bond markets are liquid. And they've been very, very proactive in that process. But getting back to the causes of the recession, commodity prices going so high that ultimately results in a recession. As Brenda said, that's not the reason for this recession. In fact, just the opposite. Oil prices are at historic lows, and the cost of gasoline is incredibly low. The fact of the matter is the demand is quite low because we're all not out there driving. So, the normal causes of this recession are not the reason behind the recession today. It's due to something that we cannot control. And one of the challenges we're all confronting is, how long are we going to be sheltered in place? How long before we get a vaccine? How long before there's testing for everybody to quarantine those who might have the pandemic and allowing others who don't to be able to go out and move their life back to a normal environment. So those are the challenges that we confront. It's something, candidly, we never had to deal with, and the Federal Reserve can't control that either. So let me stop on that and pass it back to you, Brendan.
All right. Thanks, Bob. Thanks for that commentary. Bob touched on the consumer. So everyone on this call, on this Zoom, is a consumer. 70% of the growth of our economy is made up of consumer spending. And let's face it, we're not spending right now. It's not a decision we've made on our own. We've kind of been forced into this situation. Bob mentioned oil. I've had a full tank of gas in my car for the last 2 weeks, which is highly unusual. So in past times, the low price of oil has been a definite tailwind or benefit to the consumer. It's not the case now. And you're going to see a lot of energy companies go out of business and other companies go out of business. And we have to be conscious of that when making investment decisions. Some areas of equities and fixed income look very attractive to us. Oil and energy, not one of them broadly speaking, but selectively speaking. Getting back to how, Elliot referenced investor behavior. And usually in times of panic, investors left to their own devices tend to sell when the market is distressed. When I say the market, whether it's the stock or bond market, and they tend to invest when they're feeling a lot better about things. The way to avoid those downside intra-year declines in the S&P 500, in our view at JP Morgan, is not by trying to time the market. It's by creating an asset allocation plan such that Prosperity Financial Group does, whereby when the market does go down 34%, as we did in March, maybe you're down a half or a third as much. Still a lot of pain there, but the recovery, number one, the downside is half in an ideal scenario, but the recovery period is much greater. So that's something to keep in mind. Traditionally, we've invested in fixed income. When I say fixed income, high quality fixed income, or what we call the extended sectors, high yield, global fixed income. We've invested in those in varying degrees of allocations depending on your risk tolerance. Now, in March, we saw something that was at least never seen before by myself, and I don't think Bob either, but we saw, and I know that this is a question that Elliot put out there, we saw a lot of fixed income instruments become highly correlated on the downside. And it's created opportunity. I'm going to turn it back to Bob to talk about where we see, does negative correlation to equities still exist in fixed income? Can we still protect on the downside? And what are some areas of opportunity for the investors out there? Because I know from listening to you that there are a lot of areas of opportunity.
Yeah, thanks, Brendan. March was an incredible period of time, not only for the stock market, but particularly for the bond market. And I've been in the business for many, many years. I've been through the stock market crash in the late 80s, to the tech bubble, to 9/11, to the financial crisis. And there were a couple days in March I had literally never seen before. In fact, one day I remember where the stock market was getting punished severely, and at the same time, Treasury yields were going up. In other words, the prices of U.S. Treasury bonds were dropping significantly, and the yields are going higher, and everything else in fixed income was going down in value. It's something I've never seen before. And in fact, I got emails from professionals at JP Morgan Asset Management here asking me, they all asked me the same question. They said, Bob, is the JP Morgan Treasury only money market fund money good? And I was thinking, oh my gosh, this was not a flight to quality, which is what we saw during other stressful periods and other times when stock markets got punished. It was actually a flight to cash, and not just any cash, but Treasury only cash. So that was really unusual to see stocks go down and high quality bonds go down at the same time. And as Brendan touched on, that was a period of a couple days where you had everything highly correlated to each other. Over the long run, however, high quality bonds are negatively correlated to stocks. And this is why you own them, because it's part of an overall thoughtfully diversified portfolio. So even though we had a couple days of those traditional correlations, they were thrown out the window, thanks to the Federal Reserve making sure the bond markets became liquid again and they didn't freeze up, those traditional correlations began to get back into their appropriate relationships. So what have we seen since then, where we've had stock markets down, year to date, and I don't know what it is. I don't follow stocks closely, but I know they're down. And yet you have high quality bonds having positive returns year to date, thanks to that recovery, that traditional correlation. So when you're thinking about asset allocation and you're talking to Elliot and the team, there's a reason why you own equities, maybe US and maybe, value and growth and non-US, but there's a reason why you own bonds too. And you own that high quality core fixed income. And by the way, if you're in a high tax bracket, that high quality core fixed income may be high quality, an intermediate muni bond fund or a separately managed account. That's that high quality core that over the long run is negatively correlated to stocks. So when stocks go down, those high quality bonds are going to go up in value. And as Brendan said, we think of diversification in fixed income from the perspective of a triangle where your core is at the bottom, and that's what I've been talking about, that high quality core fixed income. The middle of the triangle is what we call the core complement, which comprises inflation protection, something just outside of cash like ultra short. And then the top of the triangle is where you get that income in fixed income. That's where high yield or high yield muni or emerging market debt or global fixed income. And they play a different role. Whereas high quality fixed income, that core is negatively correlated to stocks, the income-oriented parts of fixed income, the top of the triangle, tends to have a higher correlation to stocks and have a low correlation to that core fixed income. So they play an important role in overall diversification. So the bottom line is, whereas we saw a few days of that lack of correlation between stocks and bonds, in other words, that negative correlation wasn't working, over the long run, those correlations play a very, very important role in overall diversification. So you may look at your overall portfolio and say, oh my gosh, my stocks are down, but you realize your high quality bonds have lowered your overall volatility and have actually gone up in value. And that's the beauty of having a diversified portfolio. I'll turn it back to you, Brendan.
All right. So let me, and I believe we're doing questions at the end, or maybe Elliot will have some when we're done with our portion before we turn over to Pat. But a couple things on the prior peak. When do we get back to that prior peak of the S&P 500? And Elliot alluded to it earlier. If you're bearish and you think that it's going to take from these levels, let's assume it takes 5 years to get there. At JP Morgan, we're in the 1 to 2 year camp, but let's assume you're very bearish. You think that this is going to be a 5-year process. Even at that time frame and current levels, your annualized return in the S&P 500 works out to be about 6%, a little bit over 30 compounded. If you're in the 1 to 2 year camp, like JP Morgan, let's assume you're in the 2 year camp. That's an 11% return in the S&P 500 annualized. 1 year, you're looking at about 21%. So there's a range of outcomes there. What we don't want to see people doing is going to cash at precisely the wrong time, like a lot of people did in 2009 and 10, and miss out on the recovery. The other thing I will say, we get questions on these calls every day about oil, REITs, and gold, because they've all been pretty beat up. As I said, we're negative to neutral on all these sectors. Do we think you should have exposures there? The answer is yes, but that's a very personal decision that you need to have with Elliot and his team. So in conclusion, 2021, year of the virus, year of recession. 2021, year of recovery. 2022, we think things are kind of running on full cylinder there here in the United States. But we don't want people to make investment decisions based upon panic or fear, because you tend to miss out on the upside. As Elliot said, when you give into the fear or panic instinct, you tend to do what? Sell low, buy high. And we want to be doing the opposite. So Elliot, any questions from you or the audience for Bob or I?
Sure. So let me tell you that we are preparing for clients for the fourth quarter right now, not for the second quarter. And so we are going a little bit on a heavyweight, which you were talking about. We are heavyweight consumer staples, biotech/health and technology. We are super lightweight on energy and your bank, the financial world. Sorry about that.
That's okay. We are too. I should have mentioned that.
Yeah. And so we think that's the place to be. We think other areas we're kind of neutral on, but we're definitely heavyweight on those, and we have been loading them up in client portfolios. So tell me, are we doing the right thing?
Yeah, it sounds like you're in alignment with what we think at JP Morgan. I should have mentioned, yes, we're underweight financials just because in a low interest rate environment, financials do tend to underperform. We're all working from home, except for, you at Prosperity Financial, you guys have been able to work from the office, but technology increases efficiencies. I think a lot of people, when we come out the other side of this, a lot more people will be using the technology that we're using today in the future. Consumer staples certainly have a place in a portfolio in times of recession. How are you looking at fixed income? Because I know that we see some areas of opportunity there. Did you want Bob to touch on those, Elliot?
Yeah, well, let me tell you what we're doing, and then Bob, I would love your feedback on this. So we know the clients that we have gone down significantly in high yield. We are not into bank loans. We've never been into bank loans for the most part. We think real estate is, real estate and mortgage-backed products have just gotten squashed in this illiquidity crisis, and that's been really painful for our clients, especially because last year in mortgage-backed, they made 8%. In mortgage-backed, and real estate's been paying, these REITs have been paying 7% dividends, but they're off 20-25% this year. Do we dump them? Do we stay in? I mean, there are many people here. I'm in California, Bob. I'm not sure where you are.
Bob's in California. Bob's in California.
So you know, Bob, in California, that real estate has been cuckoo. And it's just been a nonstop rocket ship up, no matter whether you're commercial or residential. We think there's going to be a rash of bankruptcies commercially. We think strip malls are going to be decimated. Forget the malls that the brick and mortar stores, everybody's been talking about it. We think restaurants are going to be decimated. San Francisco, I talked to one of the chamber recently, and they think 50% of all restaurants in San Francisco will disappear in the next 90 days. Not the next year, the next 90 days. So that's huge. We think we just don't see activity, so we see vacancies in real estate commercially, and I don't know how that doesn't spill over residentially, although we do have the tech world out here that artificially keeps us in a bubble. What's your feeling here on this, Bob?
Well, you know, your points about real estate are absolutely well taken. I mean, really the question is going to be, how long are we going to be sheltered? Because the sooner we're out of this, the more the opportunity for instance, restaurants to be able to recover some. If the number of infected ends up, as we open up from shelter, ends up increasing again, and then we have to go back into shelter again, it is going to absolutely be devastating. The problem, of course, in when you mentioned REITs, there are in most cases leverage involved, and some of them were forced out at the wrong time, and some of their holdings had to be sold. So when I look at across fixed income in areas like high yield, high yield overall was down around 20% at the low. It's now back some. It's down about 9%. Some of the securitized space where things like some of the levered REITs and others were forced out of the market, and they were forced to liquidate at the absolute wrong times. Those areas got punished severely. Some of the securitized, like non-agency mortgages and auto loans and other types of securitization, got punished equally as severely as high yield. The difference is they haven't come back as much in the markets because of all that forced selling. So your point about shopping malls, we agree. More and more, and we're all shopping differently from how we did before, thanks to the Amazon effect and the ability to do it from home. We'll have to see about how quickly we're back out there being able to go to malls. I mean, the fact of the matter is, there will be, for example, you mentioned, and I do live in the Bay Area, so you mentioned housing, and no one, right now, candidly, in San Francisco, the housing prices are actually very, very stable, even though the number of transactions have dropped dramatically. Obviously, it's not easy. You can't go in and take a tour of a home anymore for sale, and some people who want to sell their homes have been put on hold. So the prices of housing haven't dropped yet. But from commercial real estate perspective, like malls, that is going to be devastating. And there could be a long, long time before you see a recovery there, if you do at all. Overall, in fixed income, just one brief comment, we are still bigger advocates of owning high-quality fixed income. We use the term, we want to own what the Federal Reserve is buying. Because right now, if we think this economy is going to stay weak for a while, owning what the Federal Reserve buys we think is a safe place to be. The problem with that, of course, is in most cases, you're not getting much yield. If you buy U.S. Treasury bonds, 10-year U.S. Treasury bonds are yielding 0.6%. That's not a lot of yield. but there are other things you can own, like investment grade corporates. The Federal Reserve is going to start buying high yield, so there's a chance there in the future. But the bottom line is, in our fixed income, we're still thinking about maintaining that higher credit quality. Other than in the securitized space, you can own investment grade pools of auto loans or even credit card loans, the higher credit quality tranches. And I know your clients may not understand that, but the bottom line is we are still paying for, the vast majority of, if we have a loan on our car, we're still paying those loans, or maybe we get reprieve for a few months and then hopefully we're all back to work again and we'll continue to pay our loans. So that's the real challenge. But the last point I'll make again on the real estate side, from the REITs perspective, the yields that were very, very competitive, but also there was leverage involved. So they got punished pretty severely. Hopefully they will come back, but you just have to be sensitive to the leverage side of it.
Great. So I want to thank both you guys, Bob and Brendan from JP Morgan. I'll tell you a story about understanding opportunity here. And that is that I can remember when Chrysler was struggling so much as a company. Lee Iacocca was running it. They were trying to come up with a K car, if you remember them, the Chrysler LeBaron and so forth, with a different kind of chassis. And the stock was down to $2 a share. And Lee Iacocca went and made a speech to the federal government, to the Senate and the House, and said, we need money, we need you to bail us out. And there were lots of people who said, don't do it. They're a private enterprise, leave them alone. It's not our job to bail out private enterprise. Except they were the makers of the Abrams tank, which was at that time the #1 tank for the military. Of course, now, then they eventually bought Jeep and so forth. So my dad came to me and he said, hey, let's buy Chrysler too. And we talked about it. And I remember my mother saying, are you out of your mind? They're going out of business. What do you know about Chrysler? And we never did it. So look where Chrysler is now, owned by Fiat. Imagine it too, those days, we could have spent a lot of money getting a lot of, not very much money to me, buying a lot of shares, and the world would have changed. So the lesson here, Bob and Brendan, is if you've got time, then you can pick up swaths of wonderful investments at the right time, at the right price, because they're bloodied. And so we're doing that for our clients, and we are preparing for the fourth quarter and into next year with the recovery stage. So we are cautiously optimistic. We understand, again, we might test the lows, but we are cautiously optimistic. So thank you very much for being here. And now I want to turn it over to our next speaker. And Patrick Gallagher is from Neuberger Berman. And again, another very large entity out there. He's the regional vice president. One of the things that Neuberger Berman specializes in is helping clients out with estate planning issues. They're an investment company, but they touch on all these issues. So Patrick has been so kind to come in and talk about a few of these issues. And so Patrick, go ahead.
Awesome, thank you. Thank you, Elliot, for the warm introduction there. Can you guys see my screen there? Okay, great. Okay, thank you. Thank you all for joining and taking the time to jump on our Zoom today in this new reality. I'm Patrick Gallagher. I'm a client advisor. Like the other panelists here, I'm also based in the Bay Area, live in San Francisco, but my wife and I are currently nomads on the East Coast, taking care of some relatives, or maybe they're taking care of us. It's hard to tell most of the time. And for those who don't know Neuberger, we are a private employee-owned asset management firm based in New York with about $350 billion in assets under management, and that's spread across fixed income, about 150 and about 100 billion in each equities, as well as alternatives. And aside from talking about markets and helping advisors, like Elliot and yourselves manage the different market environments like Brendan and Bob patiently just went through, I've been telling this same story a lot because this is about financial wellness. And what I've been trying to tell is, by trying to help advisors help their clients. And, you know, this is not going to take as long as what Bob and Brendan had to say, because not as much changed over the last 6 months in terms of helping yourself be more prepared in your financial life. So before I go into this particular piece, the Surviving Spouse Checklist, I just want to talk a little bit about, this is one piece of a greater program called the Family Love Letter. And I just want to tell 2 brief stories about how and why this program came about, because I think it sort of makes it very relatable to people as to why this is important. And the first one is about one of the creators. He is a state attorney in Atlanta, Georgia. And now this goes back several years, but his father was a World War II veteran. His health had, you know, unfortunately started to deteriorate. He was moving into a long-term care facility. And when the estate attorney went to visit him after he had moved in, it was obvious that his health was continuing to deteriorate, but his father said to him something that he had never heard him say before, and that was that he wished to be buried at Arlington National Cemetery, which ironically is just a couple miles down the road from where I am right now. And for any of you, especially coming up on Memorial Day, thank you for any service. But as you may know, it's not simply a couple clicks to have yourself buried at Arlington National Cemetery. So within the chaos, the estate attorney, a little bit of embarrassed that he wasn't even able to prepare his own father in the way that he would, came up with this program. And then one of the other creators had a friend, you know, and I think we see a lot of this in our life currently, where, you know, there is some good that is coming out of some bad situations. And unfortunately for this friend, she found herself at the age of 38, the unfortunate widow with 2 children and a husband who had previously been married. So with 2 stepchildren, a business, a family-owned business, and a unsigned will and trust on their dining room table. So this poor friend Robin was just left in a situation that, you know, we wouldn't wish upon anyone. And she talked about how she wished that she had been more prepared. And that was sort of the genesis of the Surviving Spouse Checklist. So what this is not only a timeline, but also, or a checklist, but also a timeline of what you should be doing and helping yourself, you know, during the unfortunate circumstances where a spouse or a close family member immediately passes away. Now, a lot of my colleagues, you know, position this piece a little bit differently. I think given the current environment and the fact that, you know, I'm trying to find things for my furloughed father-in-law to do. He can only power wash the deck so often. So this is something that you can use, and I invite you all to, you know, reach out to Elliot to connect with him about, you know, working through this piece or even the greater piece, the Family Love Letter, to make sure that you have these things, you know, you are aware, you know, where they are, what they are, and what you need to do with them. And then maybe keep this piece where you keep the rest of your important documents, you know, so, and put it away, forget about it, and when you need it, it'll be there. And as I said before, that, you know, this story hasn't changed over the last 4 or 6 months, despite the current outbreak. So you know, there's not much else for me to conclude, except just you can take a look here. There are different time periods, of course, the first week, the first month, and then the first 6 months.
Thank you, Patrick. Let me ask you some questions here. What you're doing, you know,
Sure.
it's when we talk about estate planning, it is incredibly needed. It's a needed conversation, and it's hard to be positive at the same time, because, you know, somebody's going to die first in a relationship. In the industry, we always have the man die off first. That's just how it is. We kill the man off first, and then we talk about what happens if it's life insurance. We're talking about, do you have enough money to live, to pay off the mortgage, to put your kids through college, to leave money to charity, to take care of estate taxes if that's an issue, which is not much of an issue anymore. Those are not positive conversations. But the reality is that the majority of people, when a spouse passes away, they don't have enough money to live on. Many of them have to go back to work. When my dad passed away, who passed away way too young, I don't remember my mother even signing a check until just about the end of my dad's life. My dad did all that. Very traditional old world where dad paid the bills. So this was all brand new to her. And so there are some families that live in that world. So how do you have this positive conversation with clients without sending people into the morbid place that nobody wants to be?
That's a great question. I would say with the family love letter, you position it as you want to make sure that your wishes are met. So I try to position it as like doing right for yourself and what you would like to do. And this is not like who, wins the race and what you get at the end. This is more about making sure that, in the case of one of the creators, as an estate attorney, his father was a veteran, that should have been a question. That should have been maybe something he may have not even thought. So I try to always position this, and I agree. I mean, it's not no one wants to talk about this. It's important, but not always pleasant. But try to think of it as, making sure you want to get your correct directives in on it for yourself.
And so I'm also finding that it brings up a conversation of the families about where do they want their money going. So everybody in the audience here has a financial partner. It's the U.S. government. It is. If you have an IRA, a 401k, the government's going to take 1/3 to 40% of it, give or take, including the state of California or the people listening in New York and New Jersey. It's brutal. And so you have a partner, and the question is, how do you take care of that? And so have the most of the money or leverage money, which is insurance money, go to where you want your money to go. So for my wife and myself, we talk about what we want our children receiving. What do we want going to charity? We own a foundation. For some people, it's their church, it's their synagogue. For other people, their kids are their charity. And for some people, they've said, I want to die with no money in my account because I've enjoyed Europe and Asia and traveling and having a great time. So these are really good questions to have and good conversations to have. And that's what we do with clients. So if you want to have this conversation with us about where you want your money going, let's have it, because these are important conversations and they're fluid. Today you love your children, tomorrow you don't love your children. As my mother used to say, you always tend to love your children, but liking them is a whole different issue. So Patrick, I want to thank you for being on here and stimulating, getting people to think about where do you want your money going? And then if somebody dies first, which is going to happen unless you're in a car accident or a plane accident, where do you want the money going? And can the surviving spouse, a person, take care of themselves? Or do they have to go back to work or depend on Social Security, depend on government aid? And nobody wants that to happen. So thank you, Patrick. So
you're very welcome.
So we've had 3 really good speakers, topic issues. I want to tell you that next Monday, which is 4 p.m. Pacific time. So for you people in the East Coast that are listening, I know you are, grab a glass of wine, have dinner, and you're going to love what we have. Dave Rutherford is going to be our speaker. Dave is a Navy SEAL, a former Navy SEAL. We're not going to be talking about business. We're going to be talking about finding your pathway through this pandemic, because he's somebody that understands crisis. He's got a great resume of Afghanistan and Iraq. You're going to love his resume, but you're going to love what he has to say because he is a motivational speaker and I love having Navy SEALs speak to me because I always pick up something that gives me that adrenaline rush that know I'm doing things the right way and I can get better at whatever I'm doing, whether it comes to family or business or friends or exercise. And I need to lose my quarantine 8 pounds. So I've got that there, way too much corned beef and pastrami and and potatoes in my world right now. So it's going to be a great program. Later on in June, we're going to have speakers from Social Security again, cybersecurity, the marketplace, obviously we're going to talk about there. And we're going to bring in behavioral science into there. We're still in a kind of a lockdown here in California. Some of the country's opening up. I was saying, I showed this to everybody last week. I've got my New York Rangers mask. I've ordered my New York Jets mask. I'm sorry, everybody. They haven't arrived yet, but I'm rooting for my teams, and I'm a Sharks fan, but I'm doing that. I'd have a Yankees mask if I could find one, but I don't have one. But we're having a little bit of fun with that too. I've got enough toilet paper through July 4th, so I guess I got to restock up in about 2 weeks. I went to Costco over the weekend, and they were out of toilet paper. My wife and I went there, and they were before noon. They were sold out. Who's buying all this toilet paper? I still don't know that. So I want to thank everybody for being part of this. This has been a great session on that. We'll see you next Tuesday at 4 p.m. Again, Memorial Day is Monday. It's a great weekend. I was going to say go out and barbecue this weekend, invite family over. We can't do that, but you can still barbecue. Let's take a moment on Memorial Day, Monday, and let's think about all those that have given their lives, families that have sacrificed, whether they're been in our armed forces or they have been peace officers or firemen. We're thankful for them because these people make our lives better. They give us the freedom and the rights that we have. They defend us in places that no one likes to defend. I'm always reminded of the movie A Few Good Men with Jack Nicholson in Rampage, Tyrant, when he's on the stand. And he said, at the end of the day, you need me on that wall. You want me on that wall. And we do. So we thank you to all those people that have given to families that have sacrificed and lost loved ones. So happy Memorial Day to those families. Our heart goes out to you. Your team at Prosperities Financial Group. Thanks you, and have a great week, everyone.